Hello, folks. It is Wednesday, September the 27th. It's almost 3 o'clock in the afternoon on the East Coast of the United States. I need to make a correction to my last video where I said that the Fed was projecting 2 rate hikes in 2024. They're actually projecting 2 rate cuts, 2 quarter-point rate cuts in 2024, but we need to keep in mind these are the same people that were telling us that inflation was transitory. So just keep that in mind. Got some interest rate charts that we'll be looking at, and then we're going to talk about the banking system as well. This is the statement that came from the Federal Reserve after their last FOMC meeting. And we can see here, if we look at the federal funds rate, their projections, here's 2024. So back in June, they were predicting this or projecting this as the range of interest rates in 2024. And now at the latest or after the latest meeting, this is their projection. So they've actually increased their projections of the rate for 2024, which is consistent with what came out in their statement about higher for longer, higher interest rates for a longer period of time. So that's where they're projecting we'll end up in 2024. But again, these are the same people that told us that inflation was transitory. So just for the big picture, as a reminder, this is the yield on the 10-year Treasury note in the monthly time frame. So big picture, we're looking at 40 plus years of behavior in this vehicle. And so we see that back in March of 2022, we got a break of the 40-year, this in the pink channel here, that's a 40-year downtrend in interest rates. They got interest rates down in this particular vehicle to about 0.5%. If you look at the interest rates in the yen, Japan, they got down to zero, just below zero. Some of the European countries were below zero, negative interest rates. But here in the States, got down to about 0.5%. And then in March in 2022, we got a definite breakout. And of course, here we are a year and a half later, and there's no way to question that was a breakout. That was a change of trend. There's no way to argue that, oh, that's just a glitch or a temporary overthrow. We'll be back in the channel. No, no, we won't. This is a definite change of behavior. And so looking back, asking the question, well, okay, when is the last time we had a sustained uptrend in interest rates, and what did that look like? Well, that's what we have right here. From January of 63 to September of 81, interest rates were in a steady climb and reached, what was that? Almost 16% in this particular vehicle. Mortgage rates were commonly at that level if you wanted a 30-year fixed mortgage. And remember also that in that same time frame, gold and silver had increases of 16 to 24 times. So, gold went from $35 an ounce to $850 an ounce. And silver went from about $2 an ounce up to $50 an ounce. So rising interest rates are not a bad thing if you are in the correct assets. Now, if you're in stocks, real estates, etc., rising interest rates are not a good thing. So let's keep rolling here in the charts. This is just zooming in. So again, we're still looking at, this is the yield on the 10-year Treasury note in the monthly time frame. We're just zoomed in on the breakout. So this, again, the pink channel, that's our 40-year downtrend. That was the breakout in March of 2022. Solid breakout on an impulsive movement. And then focus now, this is current, this is September of 2023, where again, we've now broken out above the upper median line of this Andrews pitchfork. And again, this is a decisive, impulsive breakout. So, you can't argue that, that's just a little, it's a glitch, or it's just an overthrow, whatever, however you want to look at that. That's not the case at all. This is a decisive breakout into a new higher range, higher level. I mean, it may not be a range. It may go straight up from here. We just don't know. But anyway, this is an impulsive break higher in interest rates. U.S. dollar obviously strengthens, well, two factors, I believe, that are strengthening the U.S. dollar currently. One of them, obviously, is higher interest rates. Higher interest rates tend to correlate with a stronger U.S. dollar. And then we have the ongoing debt collapse, which is occurring globally. We don't think about that from day to day because, most of us, we're not watching the economy of the world. We're focused on, most of us are focused on work and what's for lunch, etc., raising kids, all that kind of stuff. We don't focus on the world's economy. But we are still in the midst of a global debt collapse. The global economy, in particular in the Western world, China as well, is not healthy, definitely in downtrend. A lot of the fiat currencies are in bad shape. The Lebanese pound is in really bad shape. And so anyway, strengthen the U.S. dollar. Notice that we're at a new high for 2023. So there we go all the way back to, that was March. But that was the high for 2023, and now we're above that level. So new high for the year, a lot of strength in the U.S. dollar. I think I said it last time. As global assets decline in value, holders of those assets have to cover margin loans, have to sell those assets, and doing so requires U.S. dollars. And so there is a demand for U.S. dollars that is caused by the collapse of the global economy itself. Basically, everything's priced in the U.S. dollar. That is becoming less so, but to a large extent, it's still true that most things in the world, financial world, are priced in the U.S. dollar. So as they collapse, people need U.S. dollars to cover their cover the collapse, cover margin loans largely, because institutional traders tend to use margin, basically borrowing money to make investments. So that's the U.S. dollar. Now, this article came out, that was yesterday morning, and I saw this, and I just kind of skimmed through it, and it's like, okay, that's interesting. What is Jamie Dimon up to? Jamie Dimon is an insider. We have to think of him as an insider. And so when he puts things out publicly, we have to assume that he is talking his book. Basically, he intends to make money from his public statements. And so in this article, what it was based on interviews that he did, he's hinting at 7% interest rates from the central bank. And so, 7% interest rate from the Fed would mean, 10% mortgages on 30-year fixed, higher yields across the board. Basically, I think we're currently targeting 5%. Here's Jamie Dimon warning or hinting at 7%. And so let's look at some of what he said. And of course, this highlight here, this is what I was just suggesting, that when Jamie Dimon is an insider, he's the head of JP Morgan Bank. When he speaks, he's either speaking with insider knowledge or he's talking his book, or he's doing both. And so anyway, we need to pay attention when he talks. And again, in this article, he's hinting at 7% interest rates. So threat of stagflation. Obviously, inflation is one of the big trends that's happening in the world. In my next video, what I believe will be my next video, I'll talk about inflation in food particular. So anyway, inflation is still an issue. Along with higher interest rates, I believe we will see higher inflation, and that inflation will last for years into the future. Food in particular. Continuing with the article, Jamie is suggesting that the central bank's response to stagflation, higher inflation, and a stagnant economy, that's stagflation, the two factors at the same time, their response to that will be higher interest rates. Well, that's exactly what happened in the 1970s, was stagflation, higher interest rates along with a stagnant economy. And again, during that time period, gold went from $35 an ounce to $850 an ounce, and silver went from $2 an ounce to $50 an ounce. So Jamie is making the point that, well, they're raising rates to fight inflation. That's bullshit. If they were serious about fighting inflation via interest rates, they would have to put interest rates higher than inflation. And true inflation at this point is at least 12%. Numerous analysts are talking about 25%. And then if you look at specific items, 40%. I've seen recently people talking about 40% on some food items. But anyway, this is bullshit. They're not trying to fight inflation. They're trying to protect the banking system and attract legitimate buyers for their debt instruments. But anyway, in this article, his interviews, Jamie was pointing out that the difference between 5% and 7% is more significant than the 2% difference between 3 and 5. That basically it's a exponential factor. This next 2% will have a greater impact than this 2% change did. So worst case is 7% with stagflation. Well, maybe. My bias towards higher interest rates, I don't think 7% will be the top by any means. Remember that in 1981, interest rates reached, 16%. That was the yield on the 10-year bond was 16%. So worst case, 7%, that may be optimistic. We urge our clients to be prepared for that kind of stress. And so again, this is Jamie Dimon speaking publicly. Is he talking his book? Is he talking with insider knowledge? Is he giving a hint to his clients and the hedge funds, which are essentially, subdivisions of JPM? That they play games to make them look separate, but JPM is basically the parent of any number of hedge funds. And so anyway, we have to consider that Jamie could be giving information to clients and child institutes. Here's another look at the Fed dot plot, where they're showing, 2024 rates headed lower. But of course, in this article, that's not what Jamie is getting at. He's suggesting higher interest rates. And this is quoting again, Jamie, deflationary asset unwind. It would burst a lot of asset bubbles. It wouldn't be sustainable. And so, of course, that's, again, hinting at, going to 7% interest rates would be painful throughout the economy. There's a lot of assets that would head lower. Real estate, bonds, debt instruments in general, obviously are going to head lower in price as interest rates head higher. Let's see. Again, quote from Jamie. I do not think we want a system where no bank ever fails. Well, isn't that interesting? We got the head of JPM saying that bank failures are a good thing. And again, continuing with this quote, so having a bunch of failures is not a terrible thing. Well, that's easy to say if you're Jamie Dimon, head of JP Morgan Bank. They're in a position, both as an insider of the financial system, they have easy access to cheap money, and they have a deep war chest themselves as one of the too big to fail banks. So they're in a good position to scoop up assets during failure scenarios, economic hardship. They're able to scoop in and pick up assets for pennies on the dollar, and they have a demonstrated history of doing so, which we'll look at in just a minute. And then the article continuing here, pointing out that regional banks are currently utilizing $108 billion in the emergency funding from the Fed, and we'll look at that here in a minute. So anyway, excuse me, that was an article that came out Tuesday morning. You know, the other articles out talking about that same thing. When I saw this article, you know, one of the thoughts that crossed my mind, well, you know, it's crisis capitalism. And that's what I was just hinting at. These insiders, you know, people, institutions that have access to cheap money or have a deep war chest or the ability to easily issue bonds, raise capital to purchase assets on the cheap. Well, they are and have been for years now exercising crisis capitalism, where they intentionally create a crisis because they know they're going to go in and scoop up these assets for pennies on the dollar. And so we can look at bank purchases as an example of crisis capitalism, and JPM being a key player in that arena. And then stock purchases as well, although that's not the focus, my focus specifically in this video. But keep in mind that we've got a, you know, expectation. We're headed into December, the Santa Claus rally at the end of the year, headed into, you know, December, January. Not uncommon to get a rally in stocks in that time frame. And then 2024 election, again, not uncommon to see a rally in stocks as the politically connected individuals try to make the economy look good headed into election. So we've got two events, time frames on the horizon where it would be beneficial to crisis capitalists to start by driving stocks lower, buying them at that low point with the expectation that stocks will head higher into the end of 2023 and then head higher into the election in 2024. And so anyway, just another example of how crisis capitalism shows up in our economy. This chart, this is a count or a tally of bankruptcies in the United States. We can see that they skyrocketed during the 2008 financial crisis, and that they started an upturn back in March of 2022, which coincides with the breakout. March of 2022, that's when the yield on the 10-year note broke out of that 40-year downtrend. So, you know, if you were asking the question, do higher interest rates correlate with a weakening economy and financial crises? Well, this chart would say yes. bankruptcies increase as interest rates increase. That may be a false correlation, but you could certainly draw that conclusion from this chart. So let's look at the history of JPM purchasing banks. This is just this year. This was March, or actually May, of 2023. I've got March on the brain. So this was May of 2023 when the banking crisis occurred. We had 3 significant banks failed at that time, and then a 4th bank failed not long after. So JPM stepped in and bought First Republic Bank. The FDIC covered $13 billion in losses from this bank. JPM picked up $173 billion in loans, $30 billion in securities, that much in deposits, and then got about $2 billion in tax bennies from the cost of restructuring this bank and incorporating it into JPM. So a lot of benefits that JPM picked up by buying First Republic Bank. And if you look into the details of the purchase, so they entered into a loss share agreement with the FDIC, where the FDIC agreed to cover 80% of the losses on any single-family mortgages for the next 7 years. So until 2030, the FDIC is going to cover 80% of the losses from any single-family residence mortgages that JPM picked up during the purchase of this bank. And then same story for commercial real estate mortgages for a 5-year period. So until 2028, FDIC is going to cover 80% of the losses in any commercial real estate mortgages that JPM got out of this purchase. And then isn't this sweet? JPM used $50 billion of government money, if you want to think of it as taxpayer money, your money and my money. JPM used $50 billion worth of government money to make this purchase. And it's a non-recourse loan, which means that none of JPM's existing assets are at risk. If this whole thing goes tits up and it's a total washout, JPM will walk away from this $50 billion loan and just mail the keys basically to the government. And then the government will have no recourse against JPM assets. So anyway, a very sweet purchase of this bank. And again, crisis capitalism. If you look into the details of that banking crisis, JPM and some of the hedge funds were calling around telling their clients and large investors, hey, you need to pull your money out of these banks. They're at risk. And so we saw, I forget, I don't remember if it was First Republic or I think it was Silicon Valley Bank. They had like $42 billion worth of assets withdrawn in less than a week. Because again, these large banks and hedge funds were calling up investors saying, go pull your money out of this bank. Now, you could look at that as a risk mitigation, risk avoidance strategy, or you could look at it as crisis capitalism. They were actually encouraging accelerating the collapse of those banks because they knew they were going to jump in and buy up the assets on the cheap. So anyway, that was 2023. Now back in 2008, JPM bought 2 banks, Bear Stearns and Washington Mutual. In the case of Bear Stearns, again, JPM got a non-recourse loan, basically used government money to buy Bear Stearns, and again got a loss share agreement with the FDIC. Washington Mutual was more of a outright purchase, legitimate purchase. I think JPM used just under $2 billion of their own money and then went out into the market with $9 billion worth of bonds, raised capital to buy Washington Mutual. And so anyway, those were banks that JPM picked up out of the 2008 financial crisis. Let's talk now about the health of the banking system. This is the Bank Term Funding Program. This program was created in March of 2023, March 12th of 2023. The Fed came out with this program to lend money to the banking system to prevent them from failing. That's the cover story anyway, is that, they didn't want to see any more banks failing. And so if the banks got into trouble, they could reach out and easily borrow money from this program. Now, this is supposed to be a one-year program, which ends March 11 of 2024. So 1 year after it was created, this program is supposed to end. Now, I don't expect it will end. It will become permanent, and probably, it won't be talked about. It won't be in the headlines that it has become a permanent program, but that would be my expectation, because if they end it, currently we've got banks have borrowed $108 billion from this facility, and if they end it, well, where's that money come from? It's basically they just drive another batch of banks into failure if they were to end this program. So, and this vertical line here, that was when we had the three banks that failed, and then, like I said, there was a fourth bank that failed not long after. I forget which bank it was. Let's look at, now we've got some charts. These are just miscellaneous banks. Let me back up a little bit. So if we wanted to look at which banks are most at risk from failure, we would probably start here. We'd look at, okay, which banks are borrowing money from this facility, and then we dig into that list of banks and look at other factors, how much of their asset book is commercial real estate, what's their loan to asset ratio, a number of factors that we'd look at to determine the health of a bank. But we'd probably start with banks that were borrowing from this facility as our starting point. But what I'm doing in this video is I'm just looking at, these are banks that don't look good technically from a technical analysis perspective. They may or may not be borrowing from that facility. They just don't look good from a stock perspective. And so this is PacWest. We're looking in the weekly time frame, and we can see that they've dropped significantly and have dropped below their IPO, whether they IPO'd there or that was their issue price. Anyway, they have dropped below their original price. That you would think is not a good thing. They've got a high percentage of mortgage loans in their asset book, and of course, mortgages are at risk as interest rates head higher. We can see, was this one of the banks? Did this bank already fail, Pacific Bank? I'm not sure if this bank may have already been purchased. I think this was the fourth bank. I think it was actually purchased by another bank. I'm not sure that this is still a viable bank or currently operating. Bank of America, it's not at a new low for 2023, but clearly in a downtrend, and has dropped through multiple levels of support. Moving averages currently in bearish alignment 50-day is below the 200, 20-day is below the 50. That's bearish alignment. MACD in bear mode, suggesting that the primary trend is downwards, which of course we can see that right there. And of course energy is very low. Does that mean Bank of America is going to fail? Well, no, not at all. And it's a significant bank. Obviously it's a large bank, certainly has name recognition, but so did Washington Mutual back in 2008, and it failed. So, we can't say that Bank of America is too big to fail or is immune to failure. That would not be, that just wouldn't be true. Citigroup, same thing. Not at a new low, but down here flirting with lows for 2023 and lows going back. That was the big scary plunge in 2020 where their stock got down to that point. But clearly in a downtrend based on MACD, bear mode, MACD, energy is low. This is accumulation distribution indicator. Investors are divesting themselves of shares in this bank. Let's keep rolling. Cullen/Frost, they are at a new low for 2023. We're in the daily time frame here. Bearish alignment in the moving averages. Clearly has dropped below this support level. Bear mode in MACD, energy is low. That's not a good looking bank. Home Street, similarly, here they were, whether that was IPO or just stock issuance, started at 12 bucks, 11.55 looks like. Clearly below that level, dropped below it decisively, and then tested that level from the downside, and the test failed. And they headed lower from there and currently appear to be headed lower. We're in the weekly time frame in this particular chart. Again, bear mode, but currently on a buy signal. So that's Home Street. Northern Trust, again, has dropped below the support level. Low for 2023. Downtrend, bear mode, bearish alignment of the moving average, not a good looking stock. Prosperity Bank shares, daily time frame, new low for 2023, currently, finding support along the median line of this Andrews pitchfork. Bear mode in MACD. Let's see, I don't have the moving averages. Let's look at the 20 and the 50. There we go. Bearish alignment of the moving averages. So again, another stock that doesn't look good. And I'm not by any means suggesting shorts in these stocks as an trading strategy. That I'm not a financial advisor. I'm not giving financial advice. I'm just saying that if you were interested in taking advantage of another round of bank crises, bank failures, these might be the banks you would be looking at. And again, you would start with, or I would suggest that you start with, the banks that are currently using money from this facility. So let's keep rolling. Let's look just at the stock markets, because again, higher interest rates are not conducive to higher stock markets. As interest rates go higher, stocks become less attractive. As an investor, if I can put my money in U.S. Treasuries and get 5%, 7%, like Jamie Dimon's hinting, why would I invest in the stock market? Unless, of course, it was dividend stocks that were paying those kind of dividends in a relatively low risk manner. But anyway, just in general, let's look. This is the S&P 500 daily time frame. As I pointed out, in the last video, potential head and shoulders top shown with those green arcs. If we use that as the neckline of our head and shoulders pattern, we got a gap a non-trivial gap down from that level and then a continuation lower. Yesterday, stocks headed lower as they did again today. It was looking really ugly this morning. Obviously, we've gotten a bounce later in the session. Of course, let's see, market's still open for a little while yet. This is actually a bullish candle. That's a doji. Let's draw another potential support level. We might look at something like that. And so, S&P 500 bounced at that level and got a healthy bounce. So MACD in bear mode on a sell signal, energy very low. And based on MACD, we're actually, based on MACD, S&P 500 is down at what we would call an oversold level. That based on these prior lows, we're down at that level again. And so not unreasonable to expect a bounce from this level. We'll have to see if that bounce continues or not. Notice that we have potential support, significant support at the 200-day moving average just below. Now this is the Dow in the daily time frame. Notice that it has pushed below the 200-day moving average and done so decisively. That was yesterday, and then a continuation today. Again, a big push downwards today, obviously a bounce later in the session. MACD in bear mode, currently on a sell signal. Energy is very low, so not a good look there for the Dow. NASDAQ tech stocks have been performing. They've been outperforming the general stock market for months, and we still see that today. That although the NASDAQ has dropped in recent sessions, it's still well above the 200-day moving average, currently bouncing off support. This is the lower median line of a shift pitchfork. Penetrated below this potential support level, and actually it's a support resistance level. There it was resistance, here is support. Support failed and then pushed lower this morning, bouncing along with the rest of the market in this afternoon session. MACD in bear mode on a sell signal. Energy is very low. So that's all I've got in the charts. In summary, I just want to emphasize my bias, my opinion. Interest rates are headed higher. They will be headed higher into the future. No way to tell at this point when interest rates will stop heading higher. If we look back in history, the previous sustained uptrend in interest rates happened from 1963 to 1981. That's an 18-year period, and interest rates, at least on the 10-year note, 10-year bill, no, 10 years a note, isn't it? Yeah, 10-year is a note, reached 16%. And so just, historically, that's the potential, is that we are in a multi-year uptrend for interest rates. Interest rates could head a lot higher from here, which would be suggestive of much lower stocks. Opportunity for the big players, the insiders, to exercise their crisis capitalism. Wouldn't be surprising to see another round of bank failures. And I just encourage you to protect whatever it is you consider to be your wealth, folks. Do something to protect it. Get some assets into your own hands. Have some cash on hand, whether you keep it in a safe deposit box, bury it in the garden, whatever. Have some cash on hand. Some financial advisors recommend 3 to 6 months worth of cash just to cover that much operating expenses. And then, of course, I'm a gold and silver bull. I strongly encourage everyone to have some physical silver and gold on hand. And then if you've got significant assets in tax-advantaged retirement accounts, you can protect that money with physical gold and silver. Of course, the drawback to leaving your money in tax-advantaged retirement accounts is that the IRS is very restrictive on what you do with that money. And so in the case of rolling your tax-advantaged savings into a Gold IRA, precious metals IRA, the IRS requires that a third-party custodian holds the metal. So you get some protection for your wealth with a Gold IRA, but you can't physically hold that gold in your hands. You can't take delivery of it and bury it in your garden, keep it in your home safe, put it in your bank safe deposit box. You have to let a third-party custodian hold it. So, but it is better, in my opinion, than stocks. You know, if you got a significant amount of stocks in a tax-advantaged retirement account, just give some thought to rolling at least some of that money, 5 to 10%, into a precious metals IRA. Think of it as an insurance plan for your stocks, if you will. In the link below this video, or in the description below this video, you'll find a link to Augusta Precious Metals. That's my first choice for a gold IRA company. If you reach out to them, they'll provide you with an information packet. They'll answer all your questions. They're very patient. They won't put any pressure on you to make a decision. They'll just help you through a discovery phase in determining if a precious metals IRA is appropriate for your unique circumstances and tolerance for risk. And so that's all I've got for us today, folks. Again, protect yourself. We're in some very interesting times. There's stuff going on that, I'll cover some of it in the next video, but there's stuff I can't even talk about on YouTube because the video would be taken down, and I've already got a strike against my channel, and so there's just no point in talking about it on YouTube. But if you're serious about protecting your wealth, I suggest that you go out into the alternative media and look at some of the information that's available out there. There's some big picture stuff going on right now that will definitely have an impact on us financially. So I will talk to you in the next video.